Pam DuBois, DMV Real Estate. Hello,
Okay.
Pam DuBois, DMV Real Estate, DC, Maryland, and Virginia. We are so always happy and excited that you're here with us today. Today I have with me Chanin Wisler, and she's going to share with us, she's with First Washington Mortgage, and she's going to share with us the loan process, some information about the interest rate, and some great programs that they have. First, Chanin, tell us first, I guess, a little bit about yourself and how you got started in the lending business.
Sure. I'm Chanin. I'm a licensed loan officer in Maryland, DC, and Virginia. And I've been in the lending business for about 17 years now. Right out of college, I got really lucky and got a job in the medical device as a medical device salesperson. And I did that job and loved it for about 10 years.
Okay.
And then it was about time to switch gears and do the family thing. And I figured I wouldn't really be a good mom if I had to be in the OR at 7 a.m. with scrubs and my stuff run through the sterilizer. So I figured that I wanted to try to get a different career that would allow me a little bit more freedom, and maybe freedom in the mornings.
Yeah.
And, you know, at that time, my brother said, well, why don't you join me in the mortgage business?
Oh, so your brother was in the business.
Yeah, my brother was in
Okay.
the business, and he's the one that gave me the idea. And I was already an investor, and you know, I already had a couple of properties in Maryland and Virginia.
Okay.
So it kind of made sense. I was always interested in real estate anyway, so I knew a little bit about the industry as a whole. And then I thought, well, you know, this could make it work. Maybe I could be a mom and a loan officer without stressing out too much.
Right, and it helps with the hours, basically.
A little
too.
bit, yeah. I mean, I kind of wind up working more hours than I did in medical sales, but
Yeah.
at least it's a little bit more flexible.
Yeah. What do you like? What is your motivation as far as, I guess, basically time was one of the things that got you into it?
Yeah, just
also?
owning my own business, sort of, you know. I work for someone else, but, you know, we run our business like our own business.
Right.
So,
Self-employed, being self-employed,
right.
being able to do your own hours.
Yeah, and I've
things
always
like that.
had a commission job.
Okay.
I've had some jobs that were salary plus commission, but this is, you know, pretty much.
You can make your own
you know,
hours too.
yeah.
Yeah. So I guess first tell us a little. You've been with First Washington now for how long?
For about 10 or 12 years.
Okay.
Yeah.
Okay. And as a buyer, what would you give them as far as advice? The first thing that they would do, as far as if they were thinking about buying a home, what would be the first thing that you would give them as far as advice?
That's a great question, and I think that the mistake that most folks made, no offense to my realtor friends like you, Pam, is I think people start shopping for a home before they really figure out what can they afford, what's in their budget, and can they get approved. So I think the very first piece of advice I would give anyone who's renting right now is really take a look at their budget. And I think 9 out of 10 people that I talk to, they don't even have a budget. So I would say, you know, usually I start out with asking them, you know, what do you pay for rent right now?
Right.
What do you feel is a comfortable mortgage payment? Because typically then I can back them into a sales range that makes for a comfortable payment for them.
Right.
You know, one piece of advice I tell people is, you know how you spend your Friday and Saturday nights. I don't. So you know where you like to spend your money, and you know what your habits are.
Yeah.
So there's a lot of times that a lender can pre-approve somebody for a house that's way more than the mortgage that they want to spend.
Right. What they're comfortable with.
Right. So, you know, I never want to say pre-approve somebody for a $500,000 house if they're really only comfortable paying $1,800 a month.
Right.
That just doesn't make any sense. So really, first I'd like people to look at their monthly budget, look at what they spend, look at what they'd like to save, and just feel comfortable in a certain monthly payment range. And then I can tell them, okay, well then that sounds like you should be looking in a sales price range of here to here, or something different. And then, you know, we also talk about how much down payment and how much cash they have to put towards the transaction.
Yeah.
If they need more of a down payment to fit them into a comfortable payment, to fit them into the sales price they want to be in.
Right. It makes more sense to actually find out what you're comfortable with as far as your payment, and as opposed to going out there and looking at your dream house and going, okay, this is the house I love, but when you find out about the payment, then you really can't afford it, or you really don't want a payment that high. So it makes more sense to do the legwork beforehand, so you can see what you're comfortable with.
Exactly. And you know, the internet's great, and these days it allows people to look before they contact a realtor and get an idea of maybe the neighborhood they want to be in or
Right.
the area, and it gives them a good range.
Right.
But if they don't understand what that sales price has for a corresponding mortgage payment, and you can do the online calculations, but until you really speak to a loan officer, you really don't know what your individual situation is going to be.
Right, exactly. So as far as you telling me what I am qualified for, what documents do I need to give to you in order for you to tell me exactly what I'm qualified for, my payments and things like that?
First, we start out with just the basics. I need, first I'll need to pull your credit, and then the documents you'll need to gather are your last 30 days worth of pay stubs,
Okay.
2 months worth of bank statements,
Okay.
your last quarterly retirement statement or 401k, or in this area, government workers have TSPs. So just to get an idea of your scenario.
Okay.
And then of course your ID.
Okay.
Now there are different loan programs that may require less documentation or different documentation looked at in a different way. If you are a property owner or a small business owner, or a business owner, it doesn't need to be small, I'll always need the full tax returns.
Okay.
But just for a regular W-2 type of borrower,
Just something that's,
just pay
straightforward.
stubs, 2 months of bank statements, 2 years W-2s,
Okay.
and that's about it.
Okay. And how long does this process take once they get these documents over to you?
Yeah, typically I can take a loan application over the phone and we can talk for 10 to 15 minutes.
Okay.
And then
That's
if the
good to know.
client, it's not hard, and it can be an
Exactly.
overwhelming process, but I try to make it not as intimidating as
Yeah.
people think it might be. So we can have a 10 to 15 minute chat.
Okay.
I can fill in your information online,
Okay,
and then
that's
you can
good to know.
follow up and send me your pay stubs, your W-2s, and your bank statements. And really, it only takes me 20 to 30 minutes to go through everything,
That's good to know.
look at your scenario, and then I'll pick up the phone and we'll talk again.
Okay.
Of course,
So they really don't have to even come in and sit down with you. They can actually get you all the documents over, email, whatever.
right, they can email, we have a secure fax line, I have a secure website. So,
Okay.
Somebody could, even after we talk, maybe they want to do it at home, they don't want to do it at work, and they want to be in a quiet spot, they can just upload all of their documents to my website. And then the cool thing is, you noticed at lunch, I get a text every time somebody uploads, so I know exactly when people have
She
documents
knows it's
waiting
there.
for me.
Yeah.
which is handy, which
right.
is
which is
really
great,
convenient.
actually. Yeah. So it's not that you're lost out there in nowhere land.
Right,
She
right.
doesn't know that you actually have the documents, which is a great feature. So talk to us a little bit about rent as opposed to buying. A lot of people are renting right now, and they're saying, it's a lot less expensive. I can just rent and just keep renting, and not have to worry about taking care of a property.
Right.
What
Well,
are the advantages?
I think that we know, and it's been proven that the easiest way to wealth in this country is for property ownership. And people that buy properties and hold on to them most likely make a profit.
Yeah.
Now, it's not guaranteed, and we know the market has ups and downs,
Right.
but long term, owning real estate is the way that most of the wealthy people in this country make their wealth.
Yeah. It totally makes sense. Yeah.
Yeah, and quite honestly, as a young medical salesperson, I took my earnings and bought investment properties because I
Okay.
knew this.
Yeah.
And we're in a great area. We're in Washington, D.C.
Yeah. So true.
We've got great jobs. Our unemployment rate is just about as low as it can go.
Yeah.
And even if we were to have another slowdown, our area recovers so
It
much
always
faster
does.
than the rest of the country.
Yeah.
And we're always going to have the government here. We're always going to have government jobs here. And that's why the DC metro area is such a great place.
Yeah, I couldn't agree with
To
you more.
park your
Yeah,
money in
it's-
real estate.
It's a great
I
place.
mean,
yeah.
Our population's not going down,
Yeah.
and our jobs, including Amazon coming here, we're not losing jobs.
Right.
We're gaining jobs and gaining people
Yeah.
all the time.
It's an excellent area. Even if you're moving out of the area, basically, so a lot of times just keeping the property and keeping it as an investment property makes more sense than selling it, and letting it go, because it is an investment. It's money in the bank. It's always money in the bank.
Right.
So it
And
makes more sense.
I'm glad you asked the question about. I've sat on a couple panels recently, and I've had a couple younger buyers get pre-approved with me,
Mhm.
and I'll use an example of one young couple. They recently got pre-approved with me,
Okay.
and they wanted to be pre-approved in the $500,000 range, and they had just bought 2 brand new cars.
Okay.
One car was over $700 a month,
Oh no,
and the other car was over $600 a month. So between them, they had a lot of debt.
that's a mortgage payment right there.
Right.
Yeah.
They also had, so note to self, if you're going to try to pre-qualify for a mortgage, do it before you buy the new car.
Don't buy the car.
Buy the car after you
Don't
buy the
buy
house.
the
Try to make your current car last
Right.
as long as you can.
That payment will be called against you.
Right,
basically.
right. So, and then they also had over $100,000 worth of student loan debt.
Oh wow.
So, even though they wanted to be in the $500,000 range,
Mhm.
they could qualify because of their debt load and their income up to $320,000, $340,000. And they decided that they just wanted to rent for another year.
Oh,
And
wow.
I said, well, let's take a look. You just got 2 new car loans,
Mhm.
and they were 5-year loans. The $100,000 worth of student loan debt isn't going anywhere soon. And I said, after a year, what's going to be different with your scenario?
Right.
Yeah, you might make a little more money
Yeah.
with your income, but it's with your salary, but it's not going to be that much more to cover your existing debts. And I
Right.
said, they were looking in Montgomery County, Maryland. And I said, do you believe that houses in Montgomery are going up or down in the next
Yeah.
year? What do you think? Pam?
Right. It's going up.
Right.
Yeah.
And I said, and I'm here to tell you that rates are going to be going up
Yeah.
in the
same
next
thing.
year. So in a year, you're really not going to be any better off.
Yeah.
And I said, because they didn't really have a lot of savings, they had enough for a little bit of a down payment.
Uh-huh.
But I said, you're not going to save that much money, odds are,
Right.
and your debt load is going to be the same.
If not
More.
more. Yeah.
So I said, by waiting a year, nothing's going to change with your debt to income ratios. However, the houses that you're looking at, they're not going to be the houses that you can afford.
Yeah.
Are not going to be $325,000 or $340,000. They may be $335,000, $350,000
Yeah.
in the next year. So,
Basically.
I think that there are some first-time home buyers that are hesitant to get in the market, and they're renting nice condos with stainless steel
Yeah.
and
It's beautiful. Yeah.
marble countertops, and maybe they want to have that city living feel.
Mm-hmm.
And I think that they're either not willing to give up some of their amenities or not willing to go a little further out.
Further out. Yeah.
You know, there are always the hot places in DC that everybody wants to live in, but not everyone can afford it. At least
Yeah.
not for their very first house.
Right.
You know, maybe you need to look a little bit outside, or maybe the up and coming neighborhoods in
Mhm.
DC or Montgomery County or Northern Virginia. So you may not be able to be in DuPont Circle, but maybe you can be in Columbia Heights
Right.
or somewhere else. So, you know, talking with a loan officer and getting a realistic picture of your scenario and your goals might be more helpful than already shopping online
Yeah.
for a house that you're not going to be able
You're
to
not
afford.
going to be able to afford.
And I think,
Yeah.
you know, like you had said about, you know, maybe keeping a house for an investment, your first house doesn't have to be your dream house.
Right. Very true.
And I
Yeah.
think a lot of people get stuck into that thinking.
Yeah.
And, you know, they don't have to
Okay.
have $500,000 as their first house. They could buy a $350,000 starter condo or starter townhouse.
Right. And move
Live
out.
in it for a while, maybe do some improvements, and then keep that as a rental, and then go buy something else.
Right.
Because when you're qualifying for a mortgage, you can rent out a current, or what we call trailing home,
Mm-hmm.
and use that rental income to offset the mortgage so you can qualify for the next one.
Okay.
So that's
Yeah.
a great idea for young people starting out. If
That
you've
is a
got
great
good
idea.
income,
Yeah.
you know, your first house doesn't have to be perfect to be a great thing to do and a great investment and a
Yeah.
great start to building your wealth.
Right. Yeah. Absolutely makes sense, because you are, again, you know, with rent, the money's going down the drain. So it makes more sense to invest in real estate, see what you're qualified
Right.
for, and move forward.
And you
with
know,
that.
since
Yeah.
we're talking about rent versus buy, I have a little online calculator thing with one of my rate services,
Mhm.
and it's really pretty cool to show. Like I did an example, and if someone were to buy a $350,000 house, their payment would be right around, and only put down 3%.
Okay.
So I did it with the least amount of down payment.
Okay.
You can get a conventional mortgage if your credit score is 620 or higher, okay, with 3%. And
That's great.
3% can be gifted even. So if grandma wants to give you money, if your uncle wants to give you some money, if mom
That's
and dad
great.
want to give you some money,
Yeah.
you can have multiple gifts
Yeah.
toward that 3% along with your own money. So 3% down payment
Uh-huh.
gets you a mortgage of about $22.65 for an equivalent $350,000 place in Maryland or DC or Virginia. Rent would probably be about $2,200, I'm guessing.
Yeah.
Maybe if that's a good example. After 7 years, taking into consideration your down payment,
Yeah.
and market appreciation and the money that you're paying to pay down your mortgage,
Yeah.
you would be positive $157,000.
Wow. Hear that? Yeah.
7
That's-
years. Because
that's
7 years is
great.
the average the average length of time that someone keeps a mortgage is about 7 years.
Yeah.
So either they move or they get another mortgage or they refinance. So that's why I picked 7 years. So after
Yeah.
7 years, buying a starter $350,000 house or townhouse or condo in this area, you would be $157,000 wealthier.
More. Yeah. Totally makes sense. Yeah.
When is someone going to be able to save that much?
Right. They
Hardly
can't.
ever.
Yeah.
People don't save
They
that
can't.
much. And if you just take it up to 400,000, that number becomes 169,000. And if we take it up to 500,000, that number becomes $204,000.
That's incredible. Yeah.
And these are based on historical statistics
Yeah.
and historical market appreciation. So as the market goes up and as you're paying your mortgage down, I like to tell folks that whether you're buying, if you compare it to renting, it's forced savings.
Mm-hmm.
And you're paying yourself.
Yeah.
You're not paying a landlord. And even if you're paying, say, $2,500 in mortgage, but you could rent something comparable for $2,000 or $2,200,
Yeah.
you're still being able to hold on to that equity.
Yeah.
As you pay down your mortgage, that money's yours. It's
Yeah.
not the landlord's.
Right. It
So,
totally makes sense. Yeah.
Starting somewhere is good, and you don't have to start in your, dream house.
Right.
Just start
Yeah.
somewhere,
Just
and that would
just
be
do
my
it. Yeah.
biggest piece
Just
of
do
advice.
it. Yeah.
Yeah.
I think a lot of times people also they worry about what if I buy and the market crashes? The market goes down. They always say, okay, the market's going to crash. Buy real estate. Well, the thing about it is you just hold on to it until the market comes back. You don't sell it when the market goes down. That's the biggest thing about real estate. It's just making sure that the market's right when you're ready to sell it, and just kind of keep a gauge on the market and knowing what's going on.
Right.
7 to 10 year cycle, basically. We're on the upside right now, and it's a great time to buy, get out there and buy.
Right. And you have to live somewhere.
Right.
If
why
you
not
buy a
put
place
money
that
in the
you're
bank?
happy with.
Yeah.
I mean, my house lost a ton of value. I bought at the height of the market
Yeah.
in 2006. I lost a lot of money, but this is where my family and I chose to live.
Yeah.
And I wasn't really worried that the value went down because, this was a contract that I got into with the bank.
Right.
I paid my mortgage. I didn't worry about the market. And here we are, I'm still ahead of the game now.
It's come back.
It took a little bit of time, but, as long as you have a longer term goal and it's a place that you're going to enjoy living in, it's still forced savings.
Mm-hmm. Yeah, I like that. Yeah, it's still forced savings.
Yeah.
Yeah, you hold on to it.
Rather
yeah.
than just giving your landlord $24,000, $30,000, $40,000 a year. Put that in your own pocket. Put that towards your own goals.
Right. Totally makes sense. I mean, it totally makes sense. Talk to us a little bit about the conforming as opposed to the jumbo as far as the loan amounts.
Okay,
Yeah.
so in our area, we're in what we call a high balance area. So anything below 484 and change is considered conforming loan amounts. And then we have this high balance area that's under basically 726.
Mm-hmm.
I'm sorry, they just changed it. It's 762. Anyway, it's pretty, yeah. It's high. So, and then anything over that is in a jumbo loan. So as the loan balances get bigger, the rates go a little bit higher.
Yeah. Okay. So one of the things that buyers basically are confused about, that we should talk about it a little bit, is like they'll pick up the phone, they'll give you a call, and they'll say, okay, can you tell me what the interest rate is? And they want to know what the interest rate is.
Right.
And they're puzzled why you can't tell them right on the phone. It's like, why can't you just tell me what the interest rate is?
What if they saw the matrices that I look at every day,
Yeah.
they would understand. Because each I'm losing my train of thought. Each component of your loan, underwriters call this layered risk.
Okay.
And the bank is always looking out for their interests. So they
Right.
will, raise your interest rates based on your risk. One risk factor is credit score.
Right.
You're going to get a better interest rate if you're at 720 than you are at 620.
Right.
You're going to get a better interest rate if you're at 740 rather than 580.
Yeah.
So credit score is one consideration. Whether you're buying a single family house or a condo is another
Right.
consideration. Condos are a little bit more risky because they have condo associations and condo fees, and the bank wants to know that that is a healthy association, and that if you were to default on their loan and they have to take the property back, it's going to be easy for them to sell it.
Right. Yeah.
So it depends on if you are going to take possession as an owner-occupied place, or is this your second house at the beach,
Right.
or the mountains, or is this an investment property? An investment property is a little bit more risky than an owner-occupied property, so that's going to have a little
They
bit
all
more.
take a plate. Yeah.
And then
Right.
it depends on what type of loan, whether you're going conventional, VA, USDA, or FHA. And then it also depends on how much money you're putting down.
Right.
Your rate actually differs if you're putting 3% down, or you're putting 10% down, or you're putting 20% down. So
Right.
we put all these things together, and the bank calculates the risk, and that rate, not only can it change every day, it can change during the
A
day,
couple times a day.
depending on what the market's doing. So, typically when somebody calls me and they want to ask me my rate, well, I need to know a little bit about their scenario
More
and
about them.
themselves. And it's good to have a conversation, because they might think they should be in one product, but after hearing their goals and what's going on in their life, I might be able to recommend a better product for them.
Yeah. Right.
So it's really
The whole
not
scenario, you gotta
one
find out
size fits
everything,
all.
Yeah.
And if you call someone up and you just ask them, what's your rate, and they give you something,
Yeah. Not good.
I don't know how they can do that. Whether
Not
they're
good,
just telling
yeah.
you something that you want to hear, or whether they're really interested in getting to know you and your scenario
They
and your
need to
goals. That's another thing.
Find out more about you
Yeah,
and
exactly.
your overall situation, credit score, down payment, and everything like
Yeah.
that. Totally makes sense. Yeah. Tell us, do you have special programs that you're currently offering?
Yeah, we, at First Washington Mortgage, we are kind of a hybrid. We can broker out loans, and we can also close in our own name. So we have
Okay,
so much
that's
freedom and we have such a huge portfolio of products. If you've heard of the loan program out there, I probably have access to it.
Okay,
So,
that's good to know.
Yeah, so we've got, for instance, I have some really interesting investor loans.
Okay. Tell us about that.
Typical banks want at least 20% down.
Mhm.
I've got some lenders that will do 15% down.
Okay, that's good.
I also have a debt ratio loan. Basically, we call it a no income investor loan. This is great for your investors who own multiple properties,
Okay.
or investors that have a business
Mm-hmm.
and maybe their tax returns don't tell the whole story. If their
Yeah.
tax returns don't show enough income, because self-employed folks are allowed
Right, they
to,
do. Yeah, they
you
don't
know,
tell us
deduct,
everything they did. Right.
and that's perfectly legal. You're
Right.
allowed to deduct your expenses off of your taxes.
Right.
But
That
if
makes
you
sense.
can show, let's say we do a no income investor, it's a 20% down program. I can do it down to a 620 credit score, and we just have to have the rent cover the mortgage.
Okay.
So, and in most places around here, a savvy investor isn't going to purchase a place that
That's a
the rent
positive
doesn't
cash
cover
flow.
the
Yeah.
mortgage.
Yeah.
So it's all about, as long as the property has $1 of positive
Yeah.
cash flow,
They're
you're
good.
fine. They're good.
Okay.
So that's one of the special programs we have.
They just have to show you a copy of the lease.
Yeah, copy the lease, and then the appraisal does a rental comp
Okay.
survey,
Okay.
just like and it's just a regular appraisal that we order.
Okay. That's
Yeah.
good. That's a great program. for
Yeah,
investors.
yeah.
That's actually a great program for investors.
We've also
Yeah.
got a whole bunch of first-time home buyer programs, whether it's a 3% down program or an FHA program. I even have some down payment assistance programs. There's great county programs out there that'll give you down
Yeah.
payment assistance. DC has a ton of programs. So it just depends on where they're looking
Yeah.
and what their scenario is, and I can show them, some of the down payment assistance programs, the rate's a little bit higher.
Okay.
So sometimes I can ask them, okay, well, you've got X amount. If you can just get X more, your rate can be this and your payment can be
You don't
this.
have to do that. Yeah.
And you don't have to have the higher rate. But it just depends on where they're living, what they're doing, and we'll kind of take all of their information and give them a couple scenarios so they do what's best for them.
Yeah. So if they have good credit and it's positive, then basically there's no reason why you shouldn't be able to buy because you have all these down payment assistance programs.
Right.
Basically.
There's plenty of there's FHA with down payment assistance. There's conventional with down payment assistance. So there's really, if you're a motivated buyer, there really isn't a reason other than if your credit is absolutely horrible. We can work on that, but there really isn't a reason for you not to look into buying.
And usually, sometimes with the down payment programs, there's income restrictions.
Yes, some of those down payment assistance programs, they want to give it to the people who need the money. And if you are making too much money or you show too much assets, they're not going to give you the money. It's really for the folks who are, working folks who just need a little bit of boost up.
The first-time home buyers.
Mm-hmm.
Yeah. Any kind of credit tips that you can give us?
Yeah, I do.
Setting up credit advantage.
Yeah, I teach for our local real estate association, and one of my most popular classes is an understanding credit class.
Okay.
So I have a lot of experience in what we call a rapid rescore. So the cool thing is my system, it's all automatic. And I can take anybody's credit score and run it through the system, and it'll tell me exactly what folks should do.
So
a lot of times people think
that's really good.
Yeah, a lot of times people think that you should pay off all your collections and pay things down or pay things off or close accounts. That's not always good for your credit score.
Oh, wow.
Yeah, in fact, paying old collections can actually bring your credit score down.
Really?
Yes, paying stuff to zero can bring your credit score down.
That's good to know. Yeah.
Closing accounts can bring your credit score down. So it's really imperative to talk to somebody who understands credit and how it affects scoring before you start shopping, before you talk to a realtor. To just make sure that we can get the best rate and the best program possible.
Yeah.
A lot of people don't know that each 20 points in your credit score means a better rate, is better pricing.
That's good to know too. Yeah.
So if somebody
this is a program that actually tells you what to do.
Yeah, and I share it with my borrowers, and we work on a solution. Like if I pull someone's credit and they're at a 656, well, that's really close to 660. Which is way better than if I would have priced them out at a 656. They're actually getting somebody at 640's credit score.
Right.
Or
because they're just,
interest rate.
Just missed it. Yeah.
Right. So each 20 points is a better rate. And, a lot of times I can take somebody from a 656 up to a 680 or a 700. So, my goal is to have everybody have the best experience possible with the best interest rate we can get.
Yeah.
So I usually will counsel people on how to get their credit up a little bit higher.
To get a better rate. Yeah. What about 100% financing?
We've got some options for that, and once again, with those down payment assistance programs, sometimes it comes with an income restriction, and it will also come with a reduced debt to income ratio. So you actually have to be a little bit more qualified borrower to get that extra money, but it's out there. And then there are also USDA loans,
which is also 100%.
Which is 100%, no money down. And then, of course, for all the military folks out there, veterans and active duty, and even reservists, VA loans are the best loans out there. And if you're a veteran and somebody's giving you a regular conventional loan, you should be talking to somebody else, because the VA loan is the best product out there for you. Because there's no mortgage insurance and the rates are the best in the marketplace.
Yeah, I love my VA buyers.
Always, there's no reason that a veteran or an active duty person should be doing anything other than a VA loan. And you can, I don't know if you know this, Pam, but you can even go above the high balance conforming limit with a VA loan. Like you can do a $2 million VA loan.
Really? No, I didn't know that. Wow.
You can use VA for even $1 million properties. You might have to put a little bit of down. You can't do it with a zero down, but you can put a lot less down than a conventional product.
Okay.
So anybody's best bet if they qualify is a VA loan.
Okay, so you can still do, you're doing the VA loan and maybe putting down 10% down. And
not even
10%?
No, usually it's like 2 or 3%.
Really?
Yeah.
And going up to $1 million?
Yeah. I mean, we do a calculation, but it's really the best bet.
Wow. That's great. That's great. That's good. Great information. Thank you so much. Anything else special that you want to share with us?
I don't know. I just think that, the sooner it's never too early to start.
Yeah.
Even if you think you're not going to buy until fall or next spring, it's always good to have a conversation so you can get the help that you need and the advice that you need. And,
Yeah.
Don't listen to your neighbor's friend's uncle's grandson because
Right.
they may not be an expert.
Yeah. If you need advice, you want to go to someone that is actually a professional in the field and not someone that's actually willing to give you advice that has nothing to know about what you're trying to do. And a lot of people do like to give you advice when you're trying to buy or sell property.
Right.
They're always trying to put their 2 cents in there. Want to share your number?
Sure. I'd love for anybody to call me. I'm easy to talk to, and the loan process isn't as tough as you think it is.
Yeah.
I'm at 301-526-0020.
Yeah, yeah. But she's a great person to work with. As you can see, she's a wealth of information. Thank you so much for being with us today. During the week, please check us out on Facebook Live. We'll be there sharing some information. We've got some good properties that we're going to show you this week. And we will be back again here next week at 1:30 on Wednesday. Meanwhile, have a great week, great weekend, and we're here always to exceed your expectations. Take care. Have a great week.
Yeah.
Bye-bye.